Hey everyone, and thanks for jumping back into the cryptoverse. Today's video will be geared towards new people that are looking to invest money in the cryptocurrency asset class for the first time. However, I think the principles from this video will be useful for everyone. We're going to be talking about modern portfolio theory and maximizing your Sharpe ratio, which exists on the efficient frontier. If you guys like the content, please subscribe to the channel, give the video a thumbs up. Also check out the Telegram channel, which you can find a link to in the description below. So if you're new to the space and you're looking to get into the cryptocurrency markets, one of the common questions is, where do you start, right? Where do you start in this madness that this seemingly madness of crypto? How do you start investing in this asset class? It's easy to want to go chase whatever altcoin is being shilled by your favorite YouTuber on that day. However, a lot of random microcap altcoins will not stand the test of time. So if you are speculating on them and they do well, you may consider taking profits to some of the larger cryptocurrencies. And those are the main ones we talk about on this channel. Okay, so let's suppose that you have $1,000 to invest in crypto. Where should you put it? Well, a lot of people will make these posts, say, rate my portfolio and all this, and then someone will give them their unfiltered opinion on why it's awful, probably because it doesn't include the altcoin of choice that they are hoping to see go up 1000x. But what we're going to do in this video is we're just going to be looking at fairly simplistic modern portfolio theory. We're going to be maximizing our Sharpe ratio on the efficient frontier. Okay, so if you have $1,000, where do you put it? Well, the first thing I should say is this is not financial advice. None of this is Ben's opinion. It's strictly based on historical price volatility and historical returns. Nothing more, nothing less. That's what the Sharpe ratio is built on. So you might look at this chart and not know what it means. It's the expected return versus volatility. So 1.0 represents an expected return of 100%. Okay? Now, you might say, oh, an expected return of 100%, sign me up. Well, the volatility on, say, a portfolio with an expected return in 1 year of 100% also has a volatility of around 65%, meaning that to within one standard deviation, there's a decent probability. So basically, within one standard deviation, your expected return would be 100%. Plus or minus 65%, meaning it would range from 35% up to 165%. Now, that's within one standard deviation. Obviously, there's certain probabilities that could make you lose money. But this is why cryptocurrency is the focus of this channel, because it offers such attractive risk-adjusted returns. Yes, there will be a year here and there that don't perform that well. What's a couple years among friends, right? But for the most part, as long as you're staying the course, it's hard to go wrong as long as you just stay disciplined and you keep at it. So let's try to break this down. But before we do, we have to go back to the basics, okay? So this is the efficient frontier. And it really stops right here. You could argue this part down here is the inefficient frontier. You might say, well, what the hell does that mean? What is the efficient frontier? The idea is that for a given set of cryptocurrencies, there exists a single portfolio which maximizes your risk-adjusted returns. A single portfolio which maximizes your risk-adjusted returns. So, for instance, for a given level of volatility, let's suppose you're okay with 80% volatility and you want an expected return up here of 115%, 110% or so. Let's say 112%. You're okay going with a volatility of 80% rather than, say, 65% because you want to get a higher return. There is a portfolio that consists of Bitcoin, Ethereum, and Litecoin that would exist on this efficient frontier. Now, only one. The rest would come up, each of these little, it's hard to see all these little dots, but each point is a single portfolio. This is 100,000 portfolios. This is a Monte Carlo simulation. However, with simple quadratic programming, you can identically solve for the efficient frontier or for the Sharpe ratio that basically, so the one that maximizes your risk-adjusted return. So you can solve for it using quadratic programming. You can also do it brute force Monte Carlo to get an idea as well. But there are certain portfolios that exist up here that would theoretically give you a higher return for the same level of risk or volatility, why would you want to get a portfolio that would say give you an expected return of 70% for the same level of volatility as a portfolio that could give you 110% for the same level of volatility? This is why managing your risk is so important in the market. Now, I say this is a Bitcoin, Ethereum, and Litecoin. You might be wondering why I'm including Litecoin. Well, I'm doing it to actually show that based on a lot of portfolios and maximizing your risk-adjusted returns, holding Litecoin doesn't really make a whole lot of sense. Okay, if you're a Litecoin enthusiast, again, don't take it up with me. Don't get mad at me. If you want to complain about it in the comments, it's fine. But I can be your outlet. But take it up with the data. Take it up with the historical data, because all this is taking into account the historical data. It's based on it's the expected return and expected volatility based on historical returns and historical volatility. So this is the maximum Sharpe ratio. So for those people who want to maximize their risk-adjusted returns, they want this portfolio, okay? Because it maximizes their risk-adjusted return. So for every unit of risk, they're squeezing out as much theoretical return as possible. And so basically between this white line and this white line, this would be known as your efficient frontier. You might say, well, why wouldn't you want this portfolio? This one looks to be the best. Well, you might argue that you could take on more risk if you're less risk averse and you want to take on more risk. You could come up the efficient frontier and say go for a portfolio with an expected return of 120% annually, but you're going to see more volatility, okay? And as long as you can stomach that volatility, then it's okay. Also recognize though that within one standard deviation, the portfolio that maximizes or maximizes Sharpe ratio up here would be about 120% plus or minus 100%. So it can go pretty far down within one standard deviation. Now, let's get to something a little bit more concrete so you guys understand what the Sharpe ratio is. Essentially, the Sharpe ratio is just your rate of return, RP, minus your risk-free rate. So basically treasury yields. You subtract out what you could get based on, let's say, your risk-free rate. And then you divide it by the standard deviation of the portfolio's excess return. Not the return, the excess return, which is basically how much more return could it give you over, say, the risk-free rate. So some people probably think I'm somewhat delusional and I'm talking about risk in this very convoluted way, but there is a method to the madness and we can start to quantify it, which I think will be useful to people that are wanting to invest in the market. Now, suppose that you have a portfolio that just consists of Bitcoin and Ethereum. Rather than getting a nice filled-in curve like we saw before, because you just have two assets, you just get a single line because you just have an X and a Y coordinate basically on each portfolio, and it just comes out to be a single line. So the portfolio which maximizes your Sharpe ratio based on just Bitcoin and Ethereum based on historical volatility since 2015 is 76% Bitcoin, 24% Ethereum. So essentially 76% Bitcoin, 24% Ethereum would maximize your Sharpe ratio. You might say, well, that seems like very little Ethereum. I want more Ethereum. Well, again, we're not saying that you can't have more Ethereum. We're just saying that for every unit of risk you take on, 76% Bitcoin, 24% Ethereum right now maximizes your risk-adjusted returns. Now, if you include Litecoin in the mix, it still stays the same, 76% Bitcoin, 24% Ethereum. So the funny thing about that is despite the fact that including Litecoin, theoretically, you're reducing your idiosyncratic risk because every asset that you own has some idiosyncratic risk. By having an index of assets, you cancel out the idiosyncratic risk and you just get your market risk. But actually adding Litecoin reduces your risk-adjusted returns because there's a lot of downside and the potential upside is not justified. Again, if that offends you, I would recommend pulling up a Litecoin Bitcoin chart and a Litecoin Ethereum chart. Litecoin tends to bleed against both of them over the macro scale. So the idea is not to say that Litecoin cannot go up. I do think, in fact, that Litecoin will appreciate in value. My point is that for every dollar you're putting in Litecoin, You're not putting it in Ethereum. You're not putting it in Bitcoin. Okay? Now, let's talk about something a little bit more useful. If you had $1,000, how would you divvy it up? Right? How would you divvy it up? Well, it depends on what your risk tolerance is and how much volatility you're willing to take on. If you wanted to just say be here, and by the way, these numbers up here are for some other calculation that I ran that I ended up not presenting and I just forgot to delete it. But if you're running this and you say, you know what, I want to be a little bit more risky rather than be 76% Bitcoin, 24% Ethereum, I want to have a volatility of 70% instead of 65. Where would that put you? Well, that would put you at 54% Bitcoin, 45% Ethereum, and 0.81% Litecoin. So in the portfolio that maximizes the Sharpe ratio at 70% volatility, it comes up to be about 1% Litecoin. For 75% volatility, so you're coming up the curve, you're hoping to squeeze out more return because you're coming up the curve this way, which is higher up on the expected return, you're getting less and less percentage of Bitcoin, 44.8 versus 55.1. So in this portfolio, you have a little bit more Ethereum than Bitcoin. And as you continue to navigate up the efficient frontier at higher and higher volatility levels, you're essentially looking at, in order to increase your expected return on a yearly basis, you would have to ultimately have less and less Bitcoin and more Ethereum. And the reason is because Ethereum tends to outperform Bitcoin, but it doesn't outperform it always. I mean, this is a great example. In February, Bitcoin is up about 76%, whereas Ethereum is up only like a modest 52% or so. So, you know, there are situations where it is better to hold Bitcoin, but if you're just holding for years and years and years, and you want to maximize your potential profits, and you're okay living through a lot of that extra volatility that you would get by holding Ethereum, then the higher you go up this curve, meaning the higher theoretical return based on historical returns and historical volatility, the less Bitcoin you're going to have, the more Ethereum you're going to have. If you want to be more risk averse and you don't want to be too much exposed to the potential downside of Ethereum, and you want the relative safety of Bitcoin, then over here at 76% Bitcoin, 24% Ethereum will get you there. So the first thing, or one of the last things I should say about this is every portfolio, you know, each person's perfect portfolio will depend on their own risk tolerance, okay? It will depend on how risky they want to be, and no one can tell you how risky you should be. It will depend on your own individual circumstances. I've tried to present the data here to show you that the higher theoretical return that you want, you're going to pay for it with more units of risk. So there's more downside risk the higher up you go. And you can see that here. I mean, the higher percentage up you go in Ethereum, the less you're going to own of Bitcoin. And whenever there is a correction, Ethereum will bleed more than Bitcoin, so you're going to be exposed to that downside volatility. If you want to minimize the downside volatility, then having more Bitcoin than Ethereum would help you accomplish that. For every theoretical return that you get, you've paid for it in units of risk. Okay? I hope that makes sense. Now, you might be wondering, why did I pick out Litecoin? Well, it's nice to have 3 coins here that we have data that goes back several years, because you have to, each data set has to be the same length. We can't use data for Bitcoin that goes back to 2010 and then data for Ethereum that goes back to 2015. So the data that we've used to show these results is data from 2015, from August of 2015 until the present day, okay? So it fully encompasses a lot of the various price movements we've seen over the years. If we were to rerun this calculation in a few months, the results could be slightly different. If you want to follow something like this and you start to see your portfolio become unbalanced at times or get off to some level that you're not comfortable with, imagine Ethereum goes up 2x or something, and then your Ethereum percentage gets to an uncomfortable amount. You don't necessarily have to sell it if you don't want to incur a taxable event. You could sell it, of course. Another idea is if you're DCAing into the market, you could just focus on DCAing into the coin. That will help get you to the percentage of that coin that you want to be in your portfolio. So if you're putting $1,000 into crypto, at these levels, which I mean are fairly risky levels, I'm not going to lie, I've been saying that for a long time, but they are fairly risky. But again, those people that are new don't necessarily want to miss out, and you could even argue that putting money in, even if they were to lose it all, it might be a learning opportunity. A lot of people kind of go through that phase before they really start to understand how crypto works. if you put $1,000 in and you're completely new to the space, to some degree, you have to completely write off that $1,000 and assume you'll never see it again. Okay, there's a decent chance it'll grow in value, but you should not be investing more than you can afford to lose. That's what everyone will tell you, and I will agree with that. Don't invest more than you can afford to lose, because if it goes down 80%, you need to be able to live through that and be okay. A lot of people lived through corrections in the past, and now, as long as they weren't investing in random garbage altcoins, they should be doing fairly well. So what I would first say is, if you're putting $1,000 into the market, I would start valuing my portfolio in Bitcoin. So you put $1,000 in, how much Bitcoin, what is your Bitcoin valuation worth? Okay, focus on that. Forget about the USD valuation, because it's going to be very volatile, super volatile, especially with the market as volatile as it is right now. Focus on the percentage, or the amount of Bitcoin you own, in terms of how much actual Bitcoin do you own, and what is the Bitcoin valuation worth of the Ethereum that you own, if in fact you're buying Bitcoin and Ethereum. And then try to make sure you watch those values, you watch them change over the months and over the years, and you'll get a better idea. The longer you're in crypto, the more you'll appreciate having a majority of your portfolio in Bitcoin. The shorter amount of time you're in crypto, the higher likelihood you'll appreciate having more of your portfolio in other altcoins. Okay. And so I think the people who have been here the longest, they'll probably have some small positions in some random altcoins that we're not talking about, but they probably have the majority of their portfolio in Bitcoin and Ethereum, because they simply don't want to deal with a lot of the downside risk to a lot of altcoins, because they've been burned so many times. With that said, there's a decent chance they have smaller positions in some of the altcoins, as I do. We talk about Link, ADA, and DOT a lot on the channel. I obviously have decent positions in all those. But at the end of the day, Bitcoin and Ethereum, I try to keep those two the highest percentages. Bitcoin first, Ethereum second, and the other ones kind of bringing up the last bits of the entire portfolio. So hopefully this makes sense. I know this isn't your traditional, portfolio assessment video, but I do try to present things in a slightly different way. We stick to the data, not to my opinion. The data, this is what the data suggests. If you don't like it, don't take it up with me, take it up with the data. If you guys like the content, make sure you subscribe to the channel. Definitely subscribe, give the video a thumbs up. We have the premium list. You can find a link to that in the description below if you want access to exclusive content. You'll get access to weekly premium videos, weekly reports, the risk dashboard, the Telegram alerts channel, the TradingView indicators, the Telegram chat room, and more. Make sure you guys lock in the lower rate. If you're curious why I only chose these 3 coins, it's again because of the data, historical limitations. However, we do have premium videos that go more into this and look at other coins that have, that don't have as much data, but then again, it's not as useful, and we'll probably have more of this on the premium list in the coming weeks. At the very least, subscribe to the channel, give the video a thumbs up. Thank you guys for tuning in, and I'll see you next time. Bye.